Welcome to the Chapter 9 desk lecture. We're talking in Chapter 9 all about plant assets, and you can see the theme hopefully at this point that each chapter we're basically diving a little deeper into an issue that we've pretty much already talked about, at least to some extent, and that's the same thing that's happening here in Chapter 9. You're going to see some familiar things from Unit 1, and then we're going to add a lot of flavor, hopefully, to this topic also. So first, we're going to talk about the purchasing of plant assets. I think it's important that we know pretty much what to do from beginning to end with our plant assets. And so you're going to see that in these series of 5 videos related to Chapter 9. Don't forget the cost principle. This is something that we introduced in Unit 1. And the cost principle basically states we record transactions at their costs. In this case, though, it gets a little bit interesting when we think about what's a cost. It gets a little more complicated. We don't have an invoice necessarily for fixed assets. Things can be complicated. The thing I like to bring up in class is to talk about, have you ever purchased a car before? What were those things that came up after the negotiated price? So you negotiated a price of $10,000 on a car. What else came up? So some of the things that we talk about in class are like the title fee, the sales tax, things like that. And so these are all things that would be included in the cost of that asset if you're purchasing it for a business. The rule of thumb, and the thing I always point students to do, instead of memorizing the list, because I'm about to list up a bunch of things on the screen of different things that could come up, instead of memorizing the list, which you can do, instead think about this rule, which is we record all costs necessary to get the asset ready for use. To get the asset ready for use, that's the cutoff. That's the basically the thing we're going to use to kind of measure whether it's included in the cost or not. So as an example, we purchased a truck for $10,000. The sales tax is $750, delivery fee of $400, title fee of $200. What's our journal entry given all these things? And these are all things that would be included in the price of the truck. What's our journal entry? Truck debit $11,350 and credit cash $11,350. Now, we might have done all these things on different times or dates, and so this might have been actually 4 journal entries that total $11,350. That's fine, but for our purposes in this class, just kind of consider those things all to be together. Now, obviously, this is a pretty easy example. There's no red flags. There's no ifs. There's no uncertainty. There was nothing thrown your way to distract you. That's not going to be the case on an exam or on a quiz. And so we're going to talk a little bit more about what is included and not included in these items. Your textbook, of course, can be helpful to you in this. For land, you want to look for things like broker fee surveys, delinquent property taxes. Cost of clearing the land is one I thought that was a little counterintuitive, where you buy a piece of land, and if it has a building on it, well, if you don't need that building and actually you want to get rid of that building, then removing that building is actually included in the cost of the land, which, interesting or not. For buildings, we're talking about things that costs a company incurs to get the building ready for themselves. If it used to be a bank and now it's a restaurant, well, there's going to be costs involved in that. And then with machinery and vehicles, stuff we've already talked about, delivery, insurance and transit, things like that. So these are all examples of costs that are capitalized. We use that term capitalized to mean added into the cost of the asset. Now, some things will come up during the life of an asset. Repairs will need to be incurred as well. There's 2 types of repair expenditures. That word expenditures is in your textbook, which is why I brought it up here. It's kind of it's not really that super valuable of a word. I'm not sure you'll even hear it again, but in case you do, the word expenditure just means something you spent, a cost, something you paid for. That's all it means, is paid for. So there's 2 types of repair expenditures. One's called an ordinary or revenue expenditure, and it's basically just your regular stuff. Oil changes, new tires, minor repairs, things like that. Nothing big, nothing that changes materially what the item is, just keeps it up and running the way it was when you bought it, or that's the goal. The second type is extraordinary. Here we're talking about your big stuff, something that changes the nature of the item. It takes it from a 400 square foot truck to an 800 square foot truck, that kind of thing. I have no idea if those numbers make any sense. An engine overhaul, some kind of modification, anything that adds to the life of the asset is also included as an extraordinary repair. Now, for our purposes, why do we care if it's ordinary or extraordinary? Well, it changes our entry. So for an ordinary or revenue expenditure, this is what our entry is going to be. We're going to debit some kind of expense. We're going to debit repairs expense, repairs and maintenance expense, maybe some kind of miscellaneous expense is going to be debited in that spot. For an extraordinary repair, however, we're going to capitalize those costs as well. So we're going to treat a repair cost that added to the life of the asset or modified the use of the asset, the same way as we treat the cost to get the asset up and running. We're going to add to the cost of the asset. Now, worksheet 1 is essentially summarizing what we've just gone over. It's a worksheet that summarizes some purchases as well as some repairs and asks you to determine whether it's like basically what do we capitalize. Good luck. As always, when you're done, take a break, do something else, and then come back for video 2.